Good afternoon and welcome to this month's Riffin on Real Estate Call. I'm Mike Flaherty with Alpha Centric, and I'm joined today by Spencer Rolfe from Crossing Bridge Advisors. Crossing Bridge is the sub-advisor to the Alpha Centric Real Income Fund. Spencer, thanks for joining us this afternoon.
You bet, Mike. Thanks for having me.
There continues to be an awful lot of things to kind of dig into as it relates to real estate and real assets. And this month I think is kind of interesting because you've got two opportunities here that we're going to talk about that are more event driven type of opportunities where you really have to understand what's going on not only in the capital structure but really peel the onion back to kind of really ferret out the opportunity. And the first one is with Braemar Hotels and Resorts. So when I was looking at this, Spencer, the first thing I noticed is that this is a company that's for sale. So expound on that and kind of share where you see the opportunities here.
Sure. So Braemar Hotels is a company that we've been involved in for a little bit now. Braemar's an externally managed REIT, and the asset base that they have is a portfolio of luxury hotels across the U.S. They probably have a dozen plus or so properties, and so this is a business that's exposed to travel trends, consumer income, other travel related macro drivers. But I think from a high level, when you think about hospitality and luxury hotels, this tends to be a little bit more of a resilient asset class. And these hotels and resorts tend to be landmark destinations for tourism in the markets that they operate in. And from a KPI perspective, both occupancy and average ticket per stay, we see these metrics trending above what you might find for the more average travel hospitality cohort because they are in that luxury section. So they are not necessarily as impacted by trends that you might find in the middle cohort of income generators. But but to go back to some of the nuance here, so Braemar is an externally managed REIT managed by another company called Ashford. And Braemar was actually spun out of Ashford, another publicly traded company, some time ago. And what makes this company a little bit tricky to understand is that what they've done is they have mortgage level debt on each specific property, and in some cases the properties go into a portfolio servicing one larger loan. And so from the outside looking in, it could screen as a very highly leveraged company, and we think that that's incorrect for a couple of reasons. One, the properties themselves generate very good property level cash flows, well in excess of any debt service requirements. The second aspect of it is that Ashford has a large management fee contract on the asset, and so when they report their consolidated financials, that management fee is taken out of the cash flow equation there. So if you were to look at it on a property level basis, kind of excluding the management fee, you would actually see a portfolio of really good income generating properties that can service their debt and have a lot of residual value left over, and the management fee is a problem. And this is actually not that hard of a problem to get around. You just have to get the advisor to decide to either sell the company or re-rate their contract, but it's not necessarily tied to the underlying performance of the assets. On an underlying basis, you have a lot of fundamental value here with this sort of bad contract overhang on it. And so what we did is we purchased their 2026 maturity convertible bonds
Okay.
that are issued at the parent holding level. And we bought those bonds initially, prices in the low 90s, kind of around a 10% yield to maturity. We thought that this would be a maturity that the company could easily handle. Since our initial purchases, they've sold assets, they've refinanced or pushed out the maturities of some of the mortgage level debt, And by the way, I should mention that the mortgages are non-recourse to the corporate parent. So if any of those properties did have a problem and default on their mortgage, which we don't think that they would or would be in a position to, then the lenders could just take back those assets without recourse to the corporate parent. And in some ways, that's actually beneficial to the company because then they get rid of an underperforming asset that could otherwise drag down the
Yeah,
performance.
get rid of it.
Exactly.
Right.
Exactly. So as you mentioned, Mike, the company recently put out a press release that they're putting themselves up for sale. They've actually restructured their management contract such that they could be taken out with a present value equation. And so maybe someone will buy the entire company, but if not, they've actually been very active selling properties piece by piece at pretty attractive cap rates. In fact, they just announced that they were selling their Clancy Hotel for about $115 million on about $6 million of net operating income, which is like a 5% cap rate, which is a very attractive valuation level. So we think that either a whole sale of the company will occur, or they'll just keep doing it piece by piece. And in that case, they're selling properties at cap rates that well exceed the value of the debt. So there's residual equity value left over that can be used to refinance the bond. We think ultimately that will get resolved. And so, you know, at the levels that we were purchasing, around 10% yield, was very attractive for the underlying risk we thought was in the asset.
These are hotels that are more they're more kind of like destination type places. I mean, I think that they own the Ritz-Carlton down in Sarasota,
Mm-hmm.
and you know, you go down there, you're not staying overnight. You're usually staying for a few days.
Oh yeah, no, I can personally attest that Ritz-Carlton down in Sarasota. I mean, it's right there, smack downtown, access to the beach. There's a lot that you can do there. It's a great property. But yeah, these are tourist destinations. You're not going for 1 or 2 nights. You're either you know, going there for a week vacation, or maybe you're going down for a corporate conference and you're gonna be down there for 2 or 3 days anyway. But these are good properties.
Great, great. So, well, that shares a nice convertible opportunity. Uh, let's kind of shift gears here. I know one of the other companies that you wanted to highlight was CBL and Associates, and that's more of an opportunity in their common stock. Talk a little bit about that.
Yeah, sure. So again, it's got a little bit of a sheen of complexity to it, but you know, once you get past, I think it's pretty straightforward. So CBL and Associates is a manager of shopping malls and open air centers generally. This is a company that went through a bankruptcy process during COVID. It's since emerged with less debt and I think more streamlined operations. So shopping malls, you know, I would not say are in the same category of quality, so to speak, as luxury hotels. But one thing that shopping malls do have is they have a very long tail of cash flow. And so maybe these properties trade at higher cap rates, but they still generate a really good amount of cash flow that can be used, A, to pay down debt, but B, if there is no debt, to pay shareholder returns and otherwise return capital to other stakeholders. So, like I said, CBL came out of bankruptcy. They shed a bunch of debt. They reorganized themselves. But what they've done with their corporate structure is they have very limited to no debt at the actual operating asset level that has recourse to the holding company, to the equity holders. So in the case where there's a shopping mall or an asset that doesn't perform, they just give it back to the bank. And in addition to that, they have a number of unencumbered properties, a lot of which are open air shopping centers, which are more valuable than your more traditional shopping mall, that are unencumbered, that have no debt on them, and that are directly attributable to the shareholders. So what the company's been doing is they've been using all this cash flow to pay down debt, further delever, to pay a dividend to shareholders. They've actually been increasing the dividend to shareholders. And just like the example I gave with Braemar, they are also actively selling selling assets, and they sell assets at cap rates that are better than what the market would imply that they're worth based on trading levels of both the company's equity and debt.
Spencer,
So
let me ask you, let me stop you right there for a minute because a lot of people hear shopping malls, coming out of COVID, and they still they probably twitch a little bit, but I don't think all shopping malls are created equal. Uh, does CBL have sort of a niche that they're trying to pursue here?
No, not really. I mean, you're absolutely correct that there's A level, B level, C level shopping malls. CBL definitely has, their exposure to, the B levels, some C levels. This isn't necessarily a situation where the idea isn't that, oh, well, they've got the best shopping malls, in the country. That's not what you need to work here. What you need to work here, and what they've been proving out, is that the assets that they do have are hanging in there occupancy wise. They're hanging in there foot traffic wise, and they generate a ton of cash flow. And the company's being very smart with how they allocate that cash flow. And so these are assets that are not going away next year, 3 or 4 years from now. You have all this time to harvest the cash flows and actually create incremental value from that. So they're being smart with the assets that they do have, and redeploying it into smart capital allocation decisions, a lot of which is returning capital to shareholders by increasing dividends. And the equity, we think, is the best way to benefit from this dynamic with how they set up the company, because you don't have a situation where the debt has recourse to the corporate parent. You do have optionality with whether you hang on to underperforming assets, and you have the optionality of what they could do with unencumbered assets, a lot of which are the open air shopping centers, which from a secular perspective are growing, as opposed to the shopping malls, which are not. So people are spending more time in the open air shopping center concept as opposed to your more traditional shopping malls. And so those are the best assets, and those are the assets that actually shareholders would have the easiest time getting their hands on. And so again, they're actively selling assets, they're actively making capital allocation decisions. These are all events that can influence the share price. And we think that being in the equity there makes the most sense.
All right, good. So let's leave it there for this month. Thank you very much. We appreciate everybody joining us today. And if I had to wrap up, I would just say you can see why it's so important to have expertise across the capital structure and to really be able to peel the onion back and understand what's going on there. So uh, we look forward to having you join us again next month for Riffin on Real Estate. And until then, I'm Mike Flaherty. Thank you.